Hi, everyone. Welcome to 2026 hurricane season risk, markets, and models. I'm Olivia Berkman, and I will be your moderator. I'd love to start by just going around introducing everyone. So, Karen, if you would start.
Hey, thank you, Olivia. I'm Karen Clark. I'm co-founder and CEO of Karen Clark and Company, and we are a major risk modeling company with a focus on the insurance industry.
Great. VJ, go ahead.
Hi everyone, Vijay Magnani. I am co-founder and CIO of Kingridge Capital. It's an asset management firm specializing in insurance-linked securities, and we launched last year.
Great. Patrick.
Yeah, great to be here. I'm Patrick Brown. I'm a meteorologist and climate scientist and head of climate analytics at Interactive Brokers.
Wonderful. Thanks, everyone, for joining me. Let's go ahead and jump in. My first question is, pretty general, but we're about 2 weeks into the 2026 Atlantic hurricane season. Where does everyone stand on the current season outlook? Maybe, Karen, we can start with you.
Sure. Well, as everyone probably knows, the seasonal forecasts are out, and the forecasts depend a lot on the phase of ENSO. And we're entering into a phase, the El Nino phase. And in fact, forecasters are predicting a very strong El Nino. I've heard some say a Jurassic El Nino. And what that means is some implications globally. So ENSO actually impacts the weather around the world. So the good news for the US is that it typically means a quiet hurricane season in the North Atlantic. However, it means the northwestern Pacific is likely to be highly active. Some other impacts are, say, in Australia and Indonesia, we could be seeing more wildfires. And in contrast, we're probably likely to see more flooding in California. We're likely to have a lot of those atmospheric rivers we saw several years ago. And also, we could also be seeing heightened SCS activity in the southeastern US. And there are other impacts, but those are probably the major ones that people are interested in.
Great. Um, Patrick, looking ahead, so not just the forecast numbers, but how is the risk landscape going to look? For insurers, insurance-linked securities, we're going to refer to that as ILS going forward, investors, and the broader catastrophe cat bond market right now. Tell me about what's elevated and what's underappreciated.
Yeah, I mean, Karen covered the seasonal hurricane forecast very well. I think the what's underappreciated. I always like to use the scaffolding of the equation that natural disaster risk is hazard times exposure times vulnerability. And hazards tend to get like a lot of the headlines, but when you're thinking about risk, so much of it is really embedded in just that exposure and vulnerability categories. And especially in the context of climate change influencing a lot of these hazards, we do the extreme event attribution, and we get like intensity changes of hazards on the order of 10% or something like that. And if you look at changes in exposure and vulnerability, those can be like 100 times, 1,000 times larger depending on where you're where you're looking. So I just think that that's kind of a main underappreciated aspect. When it comes to the seasonal forecast of hurricanes, if it's slightly less than normal this year, what does that mean in terms of losses? Like maybe nothing, because it all will hinge on whether or not that landfalling hurricane is 100 miles south or north of some population center. So the exposure and vulnerability categories, I'd say, are the most underappreciated.
Mhm. Vijay, you're nodding.
Yeah, no, those comments, definitely resonate with me. The world we are in, we are taking catastrophe risk from the society, right? At the end of the day, catastrophe risk transitions from policyholders, whether it's homeowners or businesses, to insurance companies, to reinsurance companies, and then to insurance-linked securities and the capital markets eventually. And those of us who have been in this space long enough know that a forecast for a seasonal count of hurricanes does not translate to loss potential. And Karen will probably expand on this much more eloquently than I, but one of the benchmark years in our industry that everybody talks about and remembers is 1992, which actually had an experience which is lower in terms of total number of seasonal hurricanes. The total number of hurricanes in 1992, which was also an El Nino year, was 4. The current forecasts are calling for 5 hurricanes and 2 major hurricanes this year. There was only one major hurricane in 1992. It just happened to be the worst major hurricane that the industry experienced in the last 40 years. It was Hurricane Andrew, which hit Miami-Dade in the worst possible location. Probably not the worst possible, but bad enough. And it caused one of the largest losses that the insurance industry experienced until then and probably since. And it turned out to be a turning point. It gave birth to a complete reset in the industry. The catastrophe risk management in domain was not even a thing then. And companies like Karen Clark's didn't even exist. She's actually, maybe, I'll let her speak to it. But, the point is, in our industry, yes, it's great to know that it's going to be a below normal season. Maybe it skews the odds a little bit. But we all, we take a defensive posture. We know that one event in the wrong place at the wrong time can cause a huge impact. So it doesn't really impact how we underwrite in a very strong way. I think the market overall in the insurance reinsurance space has benefited from some benign activity over the last 3 or 4 years, but that doesn't mean the risk has disappeared, right? The risk is still there, and I would I think in general that's what you're seeing in the market. That yes, everybody is cautiously optimistic, but still it has the discipline has not just evaporated just because of these forecasts.
Yeah, Karen, did you want to weigh in?
Yeah, I would, because one of my favorite sayings is that hurricanes are like real estate. What are the 3 most important things? Location, location, location. And Patrick and Vijay just already illustrated it. I will use a counterpoint. 2020 was a highly active season. We had 10 landfalling storms in the U.S., but none of them hit a very populated area, so the insured losses were actually below average. So I agree, and I'm happy to hear other market participants agreeing that, which we've been saying for years, is that the correlation between El Nino or I will say the activity in the basin and insured losses, it's a very low correlation. I mean, if you look at it, there is some correlation over a long period of time, but certainly it has no predictive ability for a single year.
That's fascinating. So we're going to move on to models. Karen, your company has argued that vendor cat models are frequently miscalibrated against historical loss experience. As we head into 2026, what are some of the more significant structural gaps in how commercial hurricane models represent risk, and how do you approach, those gaps?
Sure. Well, as people probably know, the way the hurricane model works is that it is based on historical data. And we, scientists fit distributions around that to project future hurricanes. So tens, hundreds of thousands, millions of future events. Now, before people start talking about climate change, I will say that KCC scientists, other science, we do climate condition the historical data, so we do account for climate change, but still you're using a relatively small sample size to project, all future scenarios or many different future scenarios. And from the traditional, or I call now first generation models, I think it was fine for frequency and severity, but where there was a lot of model miss was on the spatial, capturing the risk spatially. So for example, with hurricanes, again, there was a lot of reliance on about 150 years of data. So the storm tracks, when you're generating tracks overland, they could be clumpy because they're using random simulation techniques. So you could get geographic areas that are oversampled and undersampled, even in 100,000 year catalog. And so what was areas along the coast where there were just no Cat 5s, and you could get overly optimistic, that there was little risk there if you were an insurer, but really that was just a spatial bias. More frustrating for underwriters trying to underwrite individual locations. They would see, two locations that are pretty close together, same distance from the coast, exactly the same construction, and they would have very different loss estimates. And again, it would be obviously a problem, but it was all due to this spatial inconsistency, like some areas being oversampled and some being under. So in KCC, when we decided that we were going to get into risk modeling, one advantage I had is that I knew all the problems. I, of course, knew this problem. So we had to develop a new sampling methodology. We couldn't go with total random sampling, particularly for storm tracks. So we actually developed a joint probability method with a ternary tree structure, and I don't have time to go into the details. But basically what it does, instead of bootstrapping everything like close to historical events, it enables our scientists to determine from a meteorological perspective if we want to cover like all future tracks with their actual probability of occurring, so that we're able to do this. So it all comes down to a different sampling method that we use to build the hurricane model.
Vijay, my question is for you next. But before I get to that, I just want to encourage anybody who's watching to submit any questions that you may have. You can submit them at any time during our conversation, and I'll be sure to ask them to the appropriate person. You take advantage of this group of experts before you. So, Vijay, from a portfolio construction standpoint at King Ridge Capital, when you're evaluating ILS positions or reinsurance structures for Gulf or Atlantic hurricane exposure, how much weight do you give to vendor model output versus your own internal risk, your internal view of risk? Where do model estimates and market pricing diverge most?
Look, I would say the science and the thought behind the models that Karen was describing. Her firm is one of the pioneers in this industry. There's a handful of such firms out there that have been around long enough, have established these models. Some have become foundational to how risk is priced in the catastrophe modeling industry. We see the models more as a starting point for our portfolio management and analysis at the individual security level and at the portfolio level. Definitely not the finish point, right? Like Karen was describing, no model is perfect. They're kind of evolving over time as new information, new science comes to fore, new insights get generated when catastrophe events happen. And these models, I would characterize them as evolving with in the industry itself. So as practitioners, we take these models as a framework that is something that we can communicate risk with our peers and with the rest of the market. But then we layer on top of that our own view based on our understanding of where the gaps might be. Some models have strengths in certain areas, others in other areas. And our goal is to, make sure that, for instance, the recent insights on how climate change might be impacting different catastrophe perils is adequately represented or not, whether it's in hurricanes or wildfires or others. Typically, these models are, they are real life production solutions, right? So they have a product life cycle of 3 to 5 years before they make updates. And as practitioners, we need to reflect any new insights as soon as possible. And we might get certain information about our clients that may not be accessible to a model developer. So we try to reflect those insights in there. At the end of the day, I'd say our focus is really in the tail. It's not enough for us if the model gets the mean right? We are really focused on what happens in the 99th percentile and beyond. So those are the places where we pay a lot of attention and we build our view of risk to incrementally adapt the foundational models that we use for our use cases.
Mm-hmm. Patrick, when it comes to cat models, are there specific reasons hurricane models might systemically overstate or understate certain risks?
So I think the context of that question is that I've kind of written a lot where I've been kind of critical of high profile academic publishing and kind of how that flows through the media and public knowledge generation. And the critique there has largely been that a lot of the claims, there's very low testability. So you're talking about claims on like centennial timescales or global spatial scales where the incentives don't necessarily pull you towards accuracy because accuracy essentially will not be assessed. So an example would be projecting a big, huge loss in global GDP in 2100 relative to an unspecified and unknowable counterfactual. That kind of the incentives are such that it's kind of profile raising and prestige raising of the research, but there's no risk of essentially being wrong. And I actually don't see that in catastrophe modeling. Because it seems like it's on a much crisper cycle of being evaluated and tested than those types of models that I've been critical of. It's not perfect, obviously, that every season is probabilistic in terms of hurricanes. And so you can't really validate in the true sense. But it's, it actually strikes me as much kind of more difficult actually to convince an investor and a reinsurer that a cat model is accurate or is more accurate than a competing cat model compared to trying to convince two busy and semi-interested peer reviewers that are professors that your model that you're submitting for publication kind of contributes to the literature, so to say, or so to speak. So no, I think that testability is key, and I think that vendors and firms that are competing in that space with real data coming in are the incentives are aligned for accuracy.
Mm-hmm. Before we move on to markets, was there anything, Karen, Vijay, you wanted to weigh in on or Patrick on an earlier comment?
Well, I would pick up on what Patrick said, and I agree that a very important component of model development is testing. And I would, the word validate is kind of overused in the industry. Everybody validates a model, and then 5 years later, they get a new model that's 50% different, and then they validate that model. And I'm not quite sure what that means anymore. So I don't like this word validate. So I use verify or test as Patrick was using. That I think, and the only real test, and again, like Vijay, you're interested in the tail, the distribution. Obviously, it's very difficult to test the probabilities there, but I will say, if you look at the whole EP curve, there are two major sources of uncertainty. One is around the probability an event will occur, and two is the loss amount given an event. So by thoroughly testing the model, you can actually reduce at least that part of the uncertainty. And so, at KCC, our scientists believe it's vitally important, and we're actually the only modeling company that puts out our footprints, our intensity footprints, in real time for every event so that insurers and reinsurers can estimate what our model says for every single event. And for severe convective storm, that's every day, by the way, because there's severe weather every day. So we're at KCC very strong proponents of model testing and verification so that, insurers and reinsurers can feel comfortable that, that the model does perform pretty well when you're looking at individual events. I don't know if
Yeah, I
you
would
have
just
comment.
commend, KCC and Karen's team for doing that. I think they really, set the standard for the industry in terms of how quickly they come out with estimates right after an event. They just, it takes a lot of courage and initiative to put your, number out there right after an event. So I think they are definitely pushing the broader industry in the right direction there.
Great. So we're going to move on to markets. Vijay, ILS spreads tightened considerably after the post-Ian recalibration cycle. As we go into 2026, how is the ILS market actually pricing hurricane risk right now? Are investors getting compensated for what they're taking on?
It's a great question. So the post-Ian recalibration or reset in the industry was really a result of multiple years of volatility and modest returns that the ILS asset class had generated, and then it was capped off by Hurricane Ian, which was one of the largest. It was a Category 4 hurricane hitting Florida, caused a pretty big shock to the industry, not just the cat bond industry, but the insurance and the reinsurance industry. So there was naturally a reset, which happened on the aftermath of that. Things have settled over the last 2 or 3 years. As that reset kind of played its way out, as well as the cat activity has been benign. So things have settled. Spreads have compressed. That said, I would say the spreads are still fairly compelling in the market. They're definitely, not in the complacent territory. They're above what it was in the pre-2022 period. Definitely above the long-term average spreads that this asset class has gotten. And that's actually, why the asset class continues to grow, right? There's continued issuances in this asset class, as well as capital it continues to arrive in this asset class. I would just, now that we have passed that initial, step up, and the spreads have come in a little bit, it has opened the space for more sophisticated portfolio management as opposed to a pure beta play. It definitely favors the more prudent managers than it used to. But at the end of the day, the asset class in catastrophe bonds still generates high single digits, low double digit kind of yields, which is favorably compared to other high yield alternatives in the traditional market, wider than that, as well as on top of all of that, it's uncorrelated to any other asset class. So I think it has reached a good steady state in the net space.
Great. So this is to all of you or any of you, the reinsurance attachment point debate fundamentally changed after 2022. How is that reshaping the risk transfer chain as we go into this season, and who's most exposed if a major Gulf event occurs before June 30? Anyone want to start?
Well, I would just say that from an insurer point of view, if you look at some of the small Florida and Southeast insurance companies that are obviously exposed to U.S. hurricanes, I think historically we've realized that they're more, or they knew already, is that they're actually more exposed to multiple events per year. Because they really have to protect that retention. And if there's one, bad event, they have a lot of reinsurance cover, they're probably okay. But what's really caused some suffering in that market, especially, say, for example, in years like 2020, where there were multiple events that severely impacted some of the smaller insurers in that region.
Yeah, I would say, just to kind of build on what Karen just mentioned, the way the industry is designed, when there is low severity events with, which tend to be more frequent than the more extreme events, they tend to be, retained. The losses from those events tend to be retained at the policyholder level, at the insurance company level. Usually they purchase reinsurance at a certain attachment point that is higher. Over the past couple of years, since 2023, the attachment points have been coming down a bit. So you could see some of that loss go to the reinsurance industry, but I would say still, insurance industry and the policyholders will take a major part of the, let's say low severity, higher frequency kind of loss. However, if there was a major event, which fingers crossed doesn't happen, this year or definitely not before June 30th. But if there was a major event, that the kind of equation flips. Most of that loss does go to the reinsurance industry. That's what the reinsurance industry is designed for. And if the event was even bigger, let's say a Cat 4 or 5, then it gets into the capital markets through catastrophe response and others. So, you can think of that hierarchy or transfer of risk depending on the intensity and the frequency of the events.
Patrick, any thoughts before we move on?
It's a bit out of my lane, so I'm just learning.
Yeah. Okay. Karen, this question for you. CAT model updates, including changes to demand surge assumptions, storm surge, and secondary wind bands, have had real pricing consequences in both traditional reinsurance and ILS markets. When a vendor releases a model update, what's the right way for the market to interpret it and what's the wrong way?
Okay, well, Olivia, I am going to turn that question around because I believe the right question is, what is the correct way for a model vendor to produce a model update and release it? Now, of course, you mentioned we learn from every event. VJ mentioned, there are some things that we're going to learn about different construction types, roof age, characteristics like that. But, seeing 30, 40, percent increases in a model update, or more, which we've seen historically, to me, that says it's a crude model. I have to be honest with you. And I think this just is not going to work in the future because the world is getting more complex. The climate is changing. We have, VJ mentioned they make corrections for things between the updates, but there are things that are going to be really hard because insurers, for example, are implementing new policy conditions like roof ACV, building actual cash value. And, these are really refinements in the loss estimates that you can't just take a factor like of 2 or 1.5 and multiply the whole EP curve. And we have learnings from AI and machine learning, and these model updates need to be more frequent. I mean, at KCC, we're moving to annual model updates. So obviously, we cannot be having disruptive major changes, and we have a track record for not having disruptive updates because our models are accurate already. So if we changed it by a lot, it would become inaccurate. So we, as I said, as VJ mentioned and I mentioned, we continually put out, live events loss estimates, and we continually get the feedback. If there is an issue, we obviously are going to go in and refine the model, which there are. As I said, there are always little things that come up, even Winter Storm Fern, every event we do learn something. But the way, it should be in the future is that model updates should not be causing like big increases, then big decreases, up, down, up, down. The loss estimate should be moving asymptotically to perfection. Okay? And that is the vision of the KCC scientists, is that that's where the models are going. So we should welcome model updates, and we should know, and in fact, we're getting to the point where we can tell our clients before we even start on the update what's going to be the update and what's going to be the impact on losses. Because if you're doing an update, you must think that you need to refine the loss estimate. So you should know what you're trying to do before you even start the update. The problem with what, again, I call the first generation models is the scientists operate pretty much in a vacuum, and they just decide, as Patrick was saying, based on the latest published work of a scientist or an engineer, these published studies. But as Patrick already mentioned, that's a very low standard, because peer reviewers of these studies are not checking to make sure it's accurate. They're just saying the scientific process was correct, it's a new idea, there was nothing obviously wrong with it. But that doesn't mean it's fit for purpose. It may cause radical changes in loss estimates that are not warranted. So we really need a reset, in the modeling industry. And that's what, KCC is delivering, that a lot of this baggage, of the past, 5-6 years between model updates, 40% change, even the past, even 100% change in a hurricane model, which is absolutely ridiculous. I mean, there's no science that says the risk has changed by 100%, and the industry was kind of stuck with it. Like, what do we do? And so times are changing. The future, KCC is introducing the future, and it's going to look a lot better than the past. And it's really the job of the model vendor, not the model user, to understand their model updates and explain them properly.
That's a great point. Patrick, Vijay, anything you want to add before we move on?
That's music to my ears, what Karen just explained. So, yeah, as users and practitioners who use these models, it's one of the most frustrating experiences to have an update that suddenly changes how your portfolio's risk profile used to look, and then you have to explain to your investors. You have to reshift your portfolio. If you're a large reinsurance company, it changes your bottom line, your P&L. So I've been in the middle of those kind of boardroom meetings, and I can tell you everybody's scratching their heads, and it's so difficult to explain to a C-level executive why a profitable line of business should be shut down. That a line of business that was profitable 6 months back is now underwater because the model changed. So yes, I totally agree that the understanding is that these models are mature and sophisticated, and yes, there will be updates, there'll be new insights, but those updates and insights should be incremental and reasonable, not wholesale, completely, changing, throwing it out of the window and coming up with a completely new number. Mm-hmm. So, totally agree with what Karen explained.
Mm-hmm. So, Patrick, a couple questions for you. You are building hurricane landfall prediction market contracts at ForecastX, which is the Interactive Brokers CFTC regulated platform. If you would, walk us through the mechanics. So what does a contract look like? So how is it priced? Give us the details.
So these are...
Patrick, come a little bit closer to the mic. I think we're getting a little feedback. There you go.
Are we good now?
Can't hear you.
Cannot hear me.
A little bit. We can hear you a little bit. There you go. That's better.
Okay.
Perfect.
Okay. Yeah, so these are, they use these standard prediction market contracts, which are called state price securities. And they allow people to take financial positions on the outcome of future events. And the state price security just means that you pay a price between $0 and $1, and you get $1 if a state is met in the future, and you get $0 if the state is not met in the future. And so kind of the beauty of these is they're very simple because the price is the probability. So if a contract is priced at 60 cents, that means that the market is saying, or the market sentiment is that the probability of that event occurring is 60%. And so the exchange pair, you can either buy a yes or a no, and an exchange pairs a yes plus a no when they sum to $1 before fees. And so that's the general, that's how kind of all the prediction markets work. And so we're, interested in risk transfer and risk hedging applications for these types of contracts. And we're, still in the early days of exploring event questions. And event questions are actually not constrained to be hazard based or to be kind of like parametric insurance. But the example that I've kind of fallen back on as the canonical example is this major hurricane landfall example. So just to kind of run through some basic numbers and like how this might work. It's, so we do have a contract for will a major hurricane make landfall in Miami-Dade County in 2026. And right now that's priced at 12%. But let's just say, like, to make it even easier, let's say it's 10%. So that contract would be 10 cents per contract. And so the idea is that, because of risk aversion, that yes price would get bid up. So if the actuarial value is 10 cents, that might get bid up to, say, 14 cents. And so that would mean that the no side is actuarial value is 90 cents, but you can buy those at 86 cents. So the risk premium then is there on the no side. And so, 90 over 86 is about 5%. And this could be over, say a 3-month period in the middle of the hurricane season. There's also an incentive coupon at ForecastEx where you're, paid for putting up your collateral. But you kind of work out the numbers, and this would end up being about like a 20% return on the no side. So it makes sense from a risk hedging perspective because you're going to get a 10x return if that event occurs, and it also makes sense from a expected value on the no side as well. And so of course on the no side though, you're putting up a lot of capital, so there's different models of how margin would be used, and you'd want to, of course, make sure that if you are an investor in no's, that would be diversified across no's that are uncorrelated with each other. So those are important aspects of the problem, but that's in general, how we envision it working.
Can I ask Patrick a question?
Please.
Patrick, that's so fascinating. But what happens when a hurricane is headed towards Southeast Florida? Does the trading, does it extend into like live events, or does it stop at a certain point?
Yeah, so I think that's, one of the beauties of it is that it's live, throughout. And so that means you could jump in and hedge risk, at any time frame, provided the market is liquid. And so it may even be the case that, that risk premium gets much, much higher when a storm is in the water, because people are more, freaked out about it. And so then, the dynamics should then, have people flow to the no side as well. But yeah, I mean, event questions. So it could just be a static thing where it's Miami-Dade County in 2026, or you could have explicit live cat type contracts that appear once a storm forms. Will storm X make landfall in this region, or have winds above Y, or use modeled loss? You could say, will storm X cause this much modeled loss in this area in this time? So I think a lot of interesting applications.
Yeah, very cool.
Patrick, an argument you've made is that prediction markets solve the testability problem. They force falsifiable claims with a penalty for being wrong. So, for ILS and reinsurance underwriters who use CAT models every day, what specifically would a liquid prediction market on hurricane landfall tell them that a vendor exceedance probability curve does not?
Yeah, so I mean, there's two aspects of prediction markets that are valuable here. The one is the information value that the market is telling you, that you can just interpret the probability as price very easily. And so that's just looking in on the market. What I was just talking about before was the potential risk transfer and risk hedging applications. But I think on this side, it's the information side of things. And so, what Karen mentioned, that if a new model comes out and it's 50% more loss, and that's coming from the hazard side of things, that you have like 50% more hurricane risk than the previous model. This prediction markets could serve as a check on that. Like, do we see any change in the prediction market in terms of long-term, number of major hurricanes? Like, where did that come from in this model? So I think that information value is where this comes in. And let me tell you, these markets are so efficient. Like, once you kind of reach a critical mass, it's amazing. So I've been mostly involved in the past 4 months in the daily temperature markets, and they're the best, as far as I can tell. They're the best weather forecasts that have ever existed. So once money is on the line, it just incentivizes something that I've never seen before as a meteorologist. It's amazing how good they are. So they distill the wisdom of the crowds, and so you get enough participants, and that market signal, I think, is really valuable information.
Mm-hmm. Okay, we're going to move on. Thank you, Patrick. Vijay, from an ILS portfolio manager's perspective, if a hurricane landfall prediction market were liquid enough, could it serve as a real hedging instrument or a pricing benchmark? Or is basis risk too significant relative to what ILS structures are already doing?
Yeah, look, first of all, I would say that it's definitely a fascinating development. I think, kudos to Patrick and the team at Interactive Brokers for coming up with something like this. I think it's it's certainly worth watching. I would say from a ILS portfolio perspective, what I would be really concerned about is the basis risk, like you mentioned, because for us, for an ILS portfolio manager, it's not enough to know that a hurricane hit Miami-Dade or not, right? It's really about what it did, what track it followed before it hit Miami-Dade and after it passed through there. The size of the hurricane, even if it's a major hurricane, it can come with different attributes that can impact the loss. So it's really, the loss potential of a hurricane, which can be very different due to many factors that are, that some of them are hazard related, some of the others are vulnerability related. So at the end of the day, what we are looking to hedge is the loss in our portfolio. And any structure like this leaves a lot of basis risk on the table. That said, I would say if somebody had very high concentration in Miami-Dade, right, this could be a tactical hedge for them, because, they could get a partial hedge, and all those other basis risk elements can still, be kind of washed out, so to say, because their concentration is so intense and they don't have any other alternatives. The traditional alternatives in this business are what's called industry loss warranties. And Patrick, you might want to check out those, because I think if you can come up with a prediction market on insurance industry loss in a region, I think that will be much more interesting to the market. And then there are what's called retro contracts. These are effectively a reinsurance on a reinsurance portfolio. So that's much more custom and bespoke. And then there are, of course, portfolio hedging solutions. So, for those are the traditional hedging instruments for industry practitioners. I would say, as this prediction market matures and the products out there address some of the basis risk issues, there could be, more of an appetite for them as well. Because there's always a demand for capacity, both in steady state. Let's say in January or February, people are still trying to hedge their hurricane risk, even though if it's months away, or during the real event, right? They just might be uncomfortable with what's brewing in the ocean, and they might not like their exposures, and they might be willing to pay a premium to hedge that risk. So I think this is a great concept. It just probably needs to mature a little bit for the industry to broadly accept it.
Yeah, I agree. I mean, I would just say that it's early days, and at the beginning we're sacrificing basis risk for simplicity to
Yeah.
attract liquidity
Makes
and
total sense.
attention. It's easy for people to understand just a hurricane making landfall in a given area, but the idea is as you get critical mass and more participation, that then you can become more granular and reduce basis risk on the event question. So yeah, absolutely, we're having conversations about ILW based or modeled loss.
I know who will be on one of the sites when you put an ILW based contract. Karen will
Yeah.
have a view on that.
Yeah. And then also on the cat bond side of things, there's we have event questions at ForecastX, on the S&P 500, things like that. There's no reason that you couldn't have an event question on the UCITS
Yeah.
cat bond fund index, something like that. So there's tremendous flexibility on the event question side of things.
So this is to everyone, whoever wants to jump in first. National Oceanic and Atmospheric Administration budget cuts and federal science workforce reductions are all threatening the observational data infrastructure that underpins these models. If that data pipeline degrades, what's the first thing that breaks in how models price Atlantic hurricane risk? Whoever
should
wants to
probably-
start. Go ahead, Karen.
Yeah, I should probably jump in first on that. So I think first of all, it varies by peril. So this is focused on hurricane, but if we were talking about severe convective storm, wildfire, we use a lot. Our models ingest over 30 gigabytes of data a day from all the weather models, satellites, radar. So our, more what we call the frequency perils, we require a lot of NOAA data. For hurricane, though, as I said, it's more the traditional model, low frequency, high severity. So we have our database of historical hurricanes. Really the job of a modeling company is to give, a future view of all types of possibilities in accordance with their probabilities. It's not really our role to predict where or when a hurricane is going to make landfall. The NHC tries to do that. We have Google DeepMind, and actually you can bolt these into our model in real time if you want to, use Google DeepMind forecast tracks. But as far as the forecasting information goes in real time, that's not very critical to the real value proposition of the catastrophe models for hurricane. I would say again that answer is different for other perils.
Patrick, Vijayani.
Yeah, I mean, just in terms of bolting in, DeepMind is going to be dependent on the data assimilation for the initial condition models, and so if you lose data there, it's kind of necessarily going to degrade the models. If you lose data in terms of keeping track historically, it's going to be harder to retroactively I won't say validate, but test the models. So yeah, I mean that's always a concern. My understanding of the National Weather Service, I mean, this was a huge concern it's like 2 years ago now when Doge was at its peak, and there was National Weather Service staffing cuts, and there weren't as many weather balloons going up at that time. But my understanding now is that National Weather Service is back, kind of fully staffed, and the weather balloons are going up, and NOAA's orientation is very much around numerical weather prediction and forecasting, and the cuts have been more on the climate research side of things. So I guess I'd be interested in people that are more on the ground in that area. But my understanding is that the data assimilation and weather forecasting side of things is pretty alive and well.
Yeah, I would say that's true again, because that's a lot of all the data that we ingest, most of it is used for operational forecasting, and that has not been at risk, at least to date.
Yeah. Yeah, look, I think, foundationally, I agree, with the comments made, both by Karen and Patrick. I think, real-time data is important. You can't build an AI model just based on creativity. It needs good underlying foundational data, and if these situation were to become big, it can have impacts on the scale of the forecast, which can have impact on whether there's risk mitigation appropriately or not. It can increase the cost of risk transfer. So there are downstream impacts when you have uncertainty in the quality of the data. So it's good to hear that NOAA is not being shortchanged in this, but as a practitioner, this is important for us, and we would like for NOAA to be able to do their job. They've been doing a great job, and we'd like for them to be able to do it as effectively as they can.
Any other thoughts before we move along? Okay. So, Patrick, you've emphasized that prediction markets require credible third-party arbiters, and for weather, that's almost always a government data source like the National Weather Service. If federal observational capacity erodes, does that undermine the foundation of what makes forecast contracts trustworthy?
Yeah, so we have not seen any one of our resolution sources go offline.
Mhm.
It theoretically could threaten it if they did, but it's not. In principle, the resolution source does not have to be the government, and of course, in parametric insurance, for example, it's not. You have private third-party arbiters, so it's just much more about there being transparency and no clear conflict of interest, reducing the risk of manipulation. A private entity could totally do this. Like the exchange, for example, is CFTC regulated, which means that you have to have know your customer rules and audit trails, and so no one can trade anonymously. So if there was ever a question of did the arbiter, as an employee at the arbiter, were they trading in the market or something like that, that could be figured out. And so if that these businesses that for example are the third-party arbiters in parametric insurance, they're selling trust and neutrality and transparency, and so again the incentives seem aligned that it would be existential to their business if they were caught doing anything that undermined any of those things. So again, in principle, it does not have to be a government arbiter, but we have not seen anything taken offline.
So before I get to our last question, we have just a couple of minutes left. If anyone wants to submit questions, audience questions, that is, please do so now. And in the meantime, This is to everyone. If we're back here in 12 months and one thing has changed materially about how hurricane risk is modeled, priced, or transferred, what would you most want that to be? You can each pick one. Karen, why don't you start?
Sure. Well, obviously, I'll pick the modeled topic since that's our area. And I think, as VJ said earlier, I mean, the models are kind of fundamental now to the insurance, reinsurance, and ILS markets, and they've provided tremendous value over the years. And they are so important for so many different decisions. However, as I said earlier, at KCC, we have a very clear vision as to how the modeling paradigm, the models and the modeling paradigm can be improved. We already talked about, the model updates. We need to be updating these models at least every 2 years. We're going to every year, and we need to be carefully, putting in all new trends so that, ILS investors, reinsurers can stay up to date. I mean, I think 2 to 3 years from now, if you tell your investors that your model is 5 years old, I don't think they're going to look kindly on that. So we need to have very efficient model update processes, and users need to be able to update and implement model updates in a matter of days or maximum weeks, not months like it takes now. And so what we're doing is we'll provide, before the model update, all the documentation, all the changes to the loss estimates. So, everyone knows before they even get it exactly what's changed, why it's changed, so it can be a smooth process. I mean, I think everyone in the market would agree that that is really something to strive for. And of course, accuracy, transparency, all the model components, BJ mentioned earlier, hazard, vulnerability, financial, they're all completely transparent. There's no reason to hide anything in the models anymore. They are so complex between the models, the software. Nobody's going to be able to reproduce it. There are 3 major modeling companies now. I don't really see any of our clients trying to reproduce what we do. So it just provides more efficiency in the market if the users can see the vulnerability functions. And VJ mentioned earlier the proprietary view of risk. I mean, this is kind of a euphemism for fixing the models that you think aren't good. And I ask people, well, how come you can fix the model and the model vendor can't fix it? That just doesn't make sense. So we don't want smart people and highly paid people to be fixing models. We want those people to be using the models to find the opportunities in the market. Where's risk underpriced? Where is it overpriced? Where do we have a profitable, where can we make money? That's where these, very smart minds in this industry should be utilizing their knowledge, not in making like rate changes or this thing to fundamental changes to models. That's a thing of the past. It's archaic. We're definitely going to see much improvement on that in 12 months. We're already seeing it now.
Mm-hmm. Patrick, VJ, and then we have a question from the audience that we'll try to get to. Go ahead, Patrick.
Yeah. In 12 months, I'd like to see more adoption of prediction markets for risk hedging and risk transfer, and also, more awareness of their usefulness in this information discovery. It's been, a very interesting past year where there's been a huge, elevation of awareness of prediction markets, but unfortunately, a lot of that has been more around controversies than, on their usefulness. So, things about, the frivolous questions that some exchanges ask, and morally fraught questions having to do with war, or insider information predicting human behavior. And of course, the litigation around sports, sports gambling licensing. But those are all like new things, and prediction markets have been around actually since the 1980s, and they have a long academic history and a history of demonstrations of their usefulness. So I hope that in 12 months people are more aware of some of these useful applications.
Mm-hmm.
Yeah, and from my end, I would say more broadly, I'd like to see risk transfer to become more transparent and accessible to a broader base of capital users. Right now, a lot of our industry is very niche and limited to some very experienced practitioners. It doesn't have the access points that can attract a broad base of investors. Um, Not that I want everybody to be betting on hurricane contracts, but the broader the base of capital, the more resilient the system becomes. So I kind of see the ETFs that we have launched, the prediction markets, parametric tools, other solutions that are coming out as helping us, broaden that access and transparency, which I think, I'd like to see more of that in the next 12 months.
I know we've reached the end of our time. If any of you are able to just stay on for another moment to answer this audience question, I'm curious on your take on AI weather. As an AI scientist, we've been seeing year on year progress in the space. At Veya, we've been building next gen AI powered catastrophe models. I'm curious, what are the roadblocks for this technology to make its way into ILS? Does anyone have any thoughts?
Well, I could say that our KCC scientists are using AI and machine learning. As I said, we've archived over 100 terabytes of high resolution atmospheric data over the years, and we're using that to better predict wind patterns on wildfires, for example. Because obviously large loss wildfires are heavily dependent on the winds and they're very complex over complex topography. We're using it for more detection in a forecast mode of derechos and some other types of severe weather events. So we are applying it, and it's definitely very valuable in, again, what I say, fine tuning the models. I don't see it radically changing, the EP curves, but we're certainly employing these techniques to refine the loss estimates in very specific areas.
Yeah, I would just say that I see AI really penetrating the field, very quickly. I was in a startup called Climate AI in 2018, and that was before large language models became, synonymous with AI, and it was basically just kind of machine learning. And it's come a long way since then. But now it's the case that the frontier AI models are beating all of the traditional physics-based models. I mean, they're wrapped on top of the physics-based models, but they're actually making substantial demonstrable improvements. And I use ECMWF's AI integrated forecast system in my work, and I seeing Google DeepMind is beating the traditional models in hurricane track forecasting. So it's very exciting in terms of it seems like there was a lot of hype for a long time, and then the scale tipped very recently, where we're seeing very encouraging results from the AI models.
Yeah, I would echo that. Definitely for the short-term forecasting, we are seeing a lot of advantages from AI models. In terms of catastrophe risk models, I agree with Karen. Machine learning has been around for a very long time, so most practitioners have been using those techniques. But that said, if any new firm has new ideas that provide an edge, I think the market will be open to it, and they will get a good reception.
Great. Thank you all for taking a couple extra minutes. Thank you, Karen, Vijay, and Patrick, for your time and insights today. This has been really fascinating. And thank you to all of our attendees. We hope you enjoyed the discussion. This conversation will be available as a podcast. And our next live webinar will be focused on flood risk models and markets. So look out for registration information for that. Thank you again, everyone, and have a great rest of your week.
Thank you.